Yeah. Now, JC, I want to go to you. You bring a different aspect to your fund that most LPs don't have the expertise to do. Give us a little bit about your background and your experience in real estate, and then how you bring all of that due diligence, all that number crunching that Maria was talking about earlier, the underwriting, the analysis to the due diligence to help make the investments as safe as you can for the investors.
Yes. Yeah. Thank you, Tim. And I agree with a lot of the points that were made by Jennifer and Maria. And I agree. I'm also a spreadsheet person myself. Love data and numbers. But yeah, I'm a CIM, which is Certified Commercial Investment Member, which is a series of training and a designation process to test your comprehension and ability in commercial real estate. And that's been very valuable to me as far as like underwriting the deals that I find. And I look at a lot, but I guess not everything passes through my risk management, my risk analysis type bucket. And so I do look at a lot of the market indicators, the demand. We're investing in retail car washes. So I look at the demand factors for that types of business, as well as area competition, traffic counts, surrounding population, all those things to try to do another layer, because I really do feel like I want to have alignment in with any investor capital that I bring on, to where if it's not something I'm comfortable putting my own money, I don't want to bring on anybody else's capital. And so I always look at it from the perspective of me investing in it first. And that's been my unique secret sauce of finding deals that I invest in. So invest in very few, but the ones that I invest in, I do quite a bit of legwork and due diligence on.
And I know your last couple of funds, or the last one and the current one, you've been focused specifically on car washes. Give most everyone else, including myself and Maria and Jennifer, we focus a lot on multifamily. So
Yes.
I'm curious as to what had you choose car washes, and what is your background around that?
Yes. The reason why I chose car washes is really working with a client for the last 4 years. That's their business. Is they've done over 70 stores. They're very knowledgeable in that field, and they've already aggregated and exited two previous portfolios. So they really understand the operations and systems behind it, through knowing them and their whole family and getting very comfortable with them, and then looking at the numbers that they're producing, and seeing behind the scenes. I was very impressed with the profitability of those stores. And so while I like multifamily as well, and we've invested a lot in multifamily, I felt like car washing right now, with a proven operator, can produce a superior return. And so that's something we're focusing on in the short term. Not to say that we're really necessarily set on one asset class, but we would like to invest in things that we feel like we have a competitive advantage, and we feel like the returns right now are very high compared to other asset classes.
Yeah, and it's obviously car wash is a business. So for car wash as an investment, the operation side of it is probably the much bigger side. Is that correct, than the real estate side?
It is. The exit value is really determined by the profitability, or they've measured in metrics, EBITDA in this case. And so your exit multiple is really highly dependent on that. So operations is absolutely critical. Not that it is not important in a multifamily asset, but it is very important that you can operate efficiently and profitably, to create a good value for the investor, and also to have better exit options.
That's great. Thanks, JC. Maria, you primarily focus on multifamily. Have you considered other asset types? What have you focused more on the multifamily?
Absolutely. I do love multifamily. It is my go-to, but we like to just listen to our investors and what they're saying. So what JC's talking about is great, because I just sent out a message to all my investors. What do you want in
Mm.
2025? Would you like something like this? Kind of more of a business kind of thing. Would you like to see self-storage? Are you interested in triple net lease? Or do you want new construction, or do you only want things like cash flow from operations? And I think the reason we did primarily apartment complexes last year is we started to go more into stabilized assets that were already cash flowing, because the year before was more about the value add, big construction push. But as debt became more expensive, it was harder to do that safely because we had interest rates going so high. And when you're doing those kinds of construction pushes, you're not using fixed debt most of the time. You're using some sort of variable rate loan. And that wasn't great for 2023. So it's about listening to your investors. This year, another thing I heard from my investors is a lot of them were like, okay, we're done putting money into long-term holds for a while. We'll come back to that in 2025. We need something for short-term money, things where we can get our capital back out, stay liquid. Now, maybe my investors were just tapped out and I needed more investors, or that was a sign of the market at the time, but we listened. And so that's why we created our income fund, because people wanted some place that got them better returns than the banks. The banks they're still decreasing the rates. As the Fed drops their rates, the banks drop theirs. So CDs weren't paying as well. Money markets weren't paying as well. So we created the income fund where they can make 7 to 10% and still be liquid. They can still pull their money out of that. So I think it just comes to listening to your investors and seeing what they want. So every year we do a poll, a survey, and say, hey, what do you want to see? And I think things like car washes are becoming more popular.
Yep, for sure. All right, Jennifer, when it comes to the behind the scene of a fund, what does that entail? And also to share a little bit from both the perspective of what we do as fund managers behind the scene for our LPs, and then also share from an LP perspective, is there any difference in what they have to do investing in the syndication directly versus investing in a fund?
So it all starts with partnering first with the right operators and sponsors. You and I, Tim, specifically do a fund of funds model where we don't invest in our own assets. Or assets that we're acquiring. We partner with sponsors that are acquiring the asset. So it all starts with finding and vetting the right sponsor and operator. And once we have a relationship built, then it comes to the deal flow. So as the sponsors get opportunities to acquire a project, then we start looking at the economics of the deal, looking at the property itself, the viability of the rent, the current rent, the business plan. And then once we decide that it looks like it's a good project, at that point, we decide, how much do we want to partner with on this deal? How much capital do we want to bring to the deal? And at that point is whenever we start negotiating with the sponsor as far as what type of equity partner the fund will come in as, and at what level, and what type of economics in return that we can expect in return for our capital. And then once that is all settled, then we prepare all the materials, get everything ready to present to our investors in order to share that information with them. And then, so once we become an LP in the deal, we as fund managers, the job doesn't stop there. We essentially become the investor relations arm for the sponsor, where our fund investors, we are their point of contact. We are the one disseminating the information about the project, giving updates, giving newsletters, updates, distributions, making sure the K1s are taken care of. So essentially, if you were to invest in the deal directly, into a syndication directly, pretty much the same. You would expect to see the same level of information, except instead of coming directly from the sponsor or operator, it's coming from us as the fund manager. And so you get the same level of communication that you would get directly from the sponsor, and maybe even potentially more depending on how the fund manager handles their communication, because investors could be in multiple funds, or the fund could be invested in multiple assets. So At that point, yeah, there's monthly ongoing communications, monthly, quarterly, and annually, as the distributions are made, as the newsletters are put out, and as K1s are issued.
Very cool. And in terms of the taxes, like the bonus depreciation, does that change at all, or is that stays the same from investing directly into a syndication versus a fund?
That's a really good question. Because yes, it depends. It's deal specific, right? Of course, how much bonus depreciation is given. But no, typically there is not any difference in investing in a fund versus directly into a syndication. The bonus depreciation that is taken on a project is passed on to all of the LPs, including the fund investors. And then the fund investors allocate that paper loss or depreciation paper loss to its LPs.
Very cool. Thank you, Jennifer.